Do you think life is simpler as time evolves? For some, it can be more complicated when facing issues about health, estate plans, probate, long-term care, and more. That's why Attorney-CPA Joe Cordell hosts ElderTalk with TuckerAllen, providing intelligent answers for those thinking about their future. Here's Attorney-CPA Joe Cordell.
Welcome to another episode of ElderTalk. With us this week is an expert, a certified financial planner, to talk about key issues related to people as they retire and people who are retired. This topic never gets old with you guys. I know we regularly listen to your feedback. We know that financial planning, especially during this COVID crazy time, is a big issue to you. So we continue to bring you different voices and different perspectives related to financial matters for people as they age, as they retire. We often say in the last third of their lives. Okay. So with that in mind, do you want to introduce our wonderful guest who's appearing by popular acclamation a second time?
Yes, it is John Gallia of Gallia Wealth Management Group in Creve Coeur. And before we get to the topic, what we want to know, how's the baby? The last time John was on the show, he and his wife just welcomed a baby boy, I believe back in May.
Baby Rocco.
Yes.
See, this is the reason I have Jill on here. She's probably the only one who remembered that.
She has a great memory.
It's a female thing, I guess, you know?
There you go.
Okay, so the report's good.
Report is good. Baby Rocco is doing well. He
I love it.
is a COVID baby.
What?
Wow.
So he is, well, he hasn't had COVID.
Oh, that's
good.
what I thought you meant at first. He was born during COVID, right?
And it's been weird. You know, he hasn't been passed around as much. He hasn't seen my family as much. But the good thing about having a young kid like that, they don't know any different.
This is true.
So,
You know, that's a thought I've never had whenever you said a COVID baby. I wonder if during this lockdown period, if we're going to see a spike in population growth, in birth of children during this, you know, as
like a baby boom?
This. Yeah.
you would think.
That makes sense, I
There
would
have
think.
been similar times historically. I'm trying to think. You know, we had the first baby boom where guys were fighting in Europe. They come back home at the end of World War II.
Right.
But I know there have been similar periods where they have actually seen an increase in the birth rate. But I would expect that to follow from this period of time.
It would make perfect sense.
Yeah.
And that's a good thing. You
Yes.
know, our birth rate is suffering here in the United States. Let's go ahead and get started with John. I know everybody's anxious to hear his financial views.
And we're talking about retiring amid the pandemic. And John, what I want to know is really a strange time to retire, but what advice do you give someone as they enter retirement, especially during this pandemic?
That's a really good question. I don't think it's necessary for anybody to change their long-term goals for this pandemic. I don't think what we're going to see is anything like what we saw in 2008, 2009 when we had financial institutions collapsing. I think what we're dealing with is a short-term retraction of economic growth at levels that we probably got used to seeing a couple of years ago that were extremely high. We're not growing at that pace, and that's probably okay for right now, given what we're doing. But I don't think it's necessary for anybody to jump to conclusion and think, well, this is going to last 5-10 years.
I'm the same way. I don't see that scenario, but you hear people discussing this topic and people whose opinions I might respect on other subjects and pundits who seem to be saying implicitly, if not explicitly, that the world is forever changed in dramatic ways and that much of what we see now will continue for a long time. People won't be going on cruise ships like they used to. People won't be feeling comfortable sitting next to each other in movie theaters like they did at one time. And they just paint this very different world as if, you know, this COVID environment and this COVID set of rules is going to govern our lives in perpetuity. And I'm like you, I don't believe that. I think human beings, by their nature, they're going to spring back and they're going to go back to a normal.
Well, and I think they're just getting tired. I think they're getting COVID fatigue, if you will.
Yeah, what do they call that? Compliance fatigue or something that human beings feel when they're asked to make sacrifices. They can do it heroically for a period of time, but only for a period of time.
Right.
And I think what we've seen now, and this is my case, is our little social groups that we allowed people to come within a certain range of us or we'd spend time with was probably about 4 or 5 people back in April or May. Well, now that's slowly expanding as this lingers on. Maybe my safety group is now 10 people or 12 people because we are social by nature.
Yeah.
Yeah.
So I would think, as far as the industry when it comes to cruise ships, airline transportation, I think that will pick back up. I think people want to experience vacations. The alternative is sitting at home and doing what we're doing now. And it seems to be really, really boring for everybody.
Yeah.
You can only do so many home remodeling projects or watch so many movies or clean the house so much.
I agree.
Yeah. And I'll resist going very far down this road, but I'll raise this point, and that's that there seem to be some people, a large swath of people, and I think this breaks along political lines. I don't know why it breaks along political lines. I wouldn't have predicted this if we were having this conversation a year ago. We were saying, well, gee, what if there were a set of rules, really rigorous rules for how people have to behave in a health and environment due to some sort of crisis? I'm not sure I would have predicted that you would have the people on each side of the line that we have. In other words, conservatives end up not being the, one could argue, law and order people who might otherwise have said, oh, we've got rules, this is like a national war effort, so we make sacrifices. And it might have been liberals who, on the other hand, were saying, no, we don't like to have these restrictions on us. We're all about freedom,
right,
et cetera. So the way it's shaken out has just surprised me. And that's it's the opposite. That there seems to be a substantial percentage of our population, maybe more than 50%. I would say not more than 50% that are zealous about this, but more than 50% that are acquiescent. But there's some significant minority who just loves these rules and who really gets into shaming people who aren't participating. And even to the extent that I was in Asheville, North Carolina last weekend, and in order to get a takeout, and Asheville, incidentally, is a little like Portland, Oregon, very, very liberal. So
right.
there was this vegan restaurant I went to, so you can imagine kind of who you run into in vegan restaurants, right? Maybe it says something about us. So, but you can't go inside. You walked up to this big plexiglass window, much like you would see in a bad area of town in a convenience store, where you have those plexiglass things
right.
and you reach it, put your money through a hole, or they shoot out a metal thing for you to put it in like a bank. Well, in this case, there was this opening, and it wasn't possible to spread germs, obviously, from what I described. There's a little opening at the bottom for you to exchange your money and whatnot, but that's the way you put in your order. So I walked up to that. And the woman inside said, I'm sorry. She stepped back from this plexiglass and said, I'm sorry, but you've got to put on your mask for you to be able to put in this order.
But there's plexiglass.
It would have been impossible to
boy.
spread. But I'm using that as an illustration, and that's that there just seems to be this enthusiastic embrace of this new government role on the part of some. And it is political, in my judgment.
I believe it is, too.
There's a health component. I don't object to the health component, but there's a layer above and beyond that. And I think that's really what is the source of friction with many conservatives or people from states like Texas. I think much of the friction is their sense that this is more than a health issue. This is more about submitting to authority, governmental authority, happily.
I agree. I believe that we have become so polarized. You're either left or right. There's no middle ground. And I think depending on what side you are is how you view this pandemic and social guidelines. Food for thought. I'm interested to see after the election, we're going to have a president in some party that's going to be around for 4 years, whether you like it or not. But it's going to be 4 years.
He may not be around for 4 years, but his vice president will be there.
Exactly, right.
He'll be around, but he may not be governing.
Exactly. But I'm wondering if maybe we kind of let go of this whole polarized view on social distancing once the election is done.
That's an interesting thought.
Wondered about that myself, and I think that's very likely.
That's certainly Trump people's argument, is that this is being used to create distress, to create fear, and to generate more votes for Biden. I know Trump's people have said that. I don't. that's probably a less concerning perspective than the one that says, we have a very large percentage of our population that is very supportive of government command over the economy and our lives, and that embrace it enthusiastically. So that is a more concerning perspective than just saying, oh, this is a tactic for an election. And it's probably a little bit of both.
Sure. And I'm wondering how much of one or the other it actually is. And I guess in a month we'll see.
Well, and that leads to a good question. So when you look here and you're advising clients about what their investments are, and again, focusing on your older clients, which a substantial percentage of your clientele is 60 and older, what do you say to them when they might wonder, well, gee, depending on who's elected, that it may not be good for the stock market, or it may be good depending on their perspective? What do you tell them about how the political environment is going to affect the next several years?
Sure. I think both sides have their positive qualities. Obviously, the Republican side is going to be more geared toward corporate benefits, right?
Lowering. Do you think
taxes.
Corporations may lose their tax exempt or tax deduction?
Could be a possibility. Not right away, hopefully, but within 4 to 8 years, absolutely. I really think during this pandemic that the deficit is probably we shouldn't focus on that as much as we normally would. We're trying to get economic recovery, okay? So We're going to run a deficit. That's the way it is. But, depending on, let's say the Democrats win the election, there are some positive things where they're trying to get another stimulus bill out that, the Republicans are a little bit hesitant on. Maybe some of the trade talks with China go a little better, because that played a major role in the market before this pandemic hit. So the big key with the election, and I try to keep this into perspective, Wall Street does not like a Senate, Congress, and president all in the same party, because that will probably dictate major policy change. They don't like major policy change. Wall Street does not like it. They like when nothing gets done, because that's predictable. So I think depending on who is the president, or what party is in charge or
who's
running
controlling
the president.
The House and the Senate, sure.
You're right. It really doesn't matter as long as the Senate and the House and the presidency doesn't belong to one political party.
Yeah, that makes sense.
And John, I'm wondering, what are you hearing, if anything at all, from your clients who are entering retirement, say in the next few months? Are any of them saying, maybe I should hold off, because of the pandemic, hold off maybe another year? Or do you hear anything like that?
From retirement?
For retirement, yes.
I really don't see that as far as the folks that are retiring. I think most people are keeping in perspective that this is probably a short-term hiccup that we're having, and we've had substantial growth over the past couple of years. But I don't think anybody is really thinking longevity, that this pandemic is going to play a major part in their portfolio returns.
Yeah, in fact, it's paradoxical that here we are in the midst of an economic crash in some senses of the word, and Europe too, and yet the market is doing so well. It's just,
we've talked about that before, and really, how do you make sense of that?
But these people, though, I wanted to tie it in though with your
Sure.
point, is that in this case, unlike in 2008. When you did have a market crash all the way down to almost 50%. And now if they're relying on their 401k, then their 401k is probably looking pretty good right now for the most part.
I agree. I'm going to kind of hit that point that you mentioned earlier about the market doing so well despite all the economic data. The market right now I kind of liken to betting on football. Okay, third quarter earnings don't have to be great. They just have to beat expectations. So it's kind of like covering the spread. Your team doesn't really have to win. They just have to beat expectations for you to come out ahead. And we've seen that a lot in the third quarter, where a company is supposed to be down 15% based on their estimates, and they come back and they're only down 9%. Well, that stock just went up in value because they beat expectation. In all essence, all they did was cover the spread. they're not winning. So we're really kind of seeing that, and that helps the market. You don't have to have a profit to have the market increase.
But when you think though about companies, yes, there is that large percentage who's exceeding expectations, and then you have this other group that seems to be very small but so powerful, like the FANG companies, that truly are, I mean, to a large extent, they're supplying the world. If we include Alibaba and a few others in Europe and Asia. So you have this handful of companies that, through their services, people around the world are functioning remotely. And they're having everything delivered to their homes. And it's just this huge windfall for these 4 or 5 companies. But those indexes that are based on what's called capitalization, and I guess you should explain that so people will get it, why they can actually account for like 80% of the rise. So when you see, for example, the S&P or NASDAQ has a few, if you see these indexes that we all hear about going up, you would, at a glance, you would think, oh, all these stocks are doing great. But that doesn't mean that, because the way that those indexes are calculated, you could have, and you have had, literally 4 members on that list or 5 companies on that list that are accounting for like 75% of that increase in value.
Yes.
It's really misleading. And it is the tale, correctly, of a handful of companies who are just, this has just been this huge gold mine for them, quite frankly, COVID-19.
Right.
And for the rest of the Main Street companies, this has been a terrible development.
Absolutely. Market capitalization, when you look at the S&P 500, I think 35% is information technology, 20% is consumer discretionary, right? Well, when we have these companies increasing by 45% during this pandemic, the companies that deliver goods to your doorstep or the companies that are positioned well through the pandemic, they are the ones that are carrying the S&P 500 to their record highs.
That makes sense, sure.
The energy sector is still down substantially from February. There's other sectors that haven't performed as well, and they're dragging it down. But when you have the capitalization or the heavy hitters that make up the S&P 500 performing so well, these 4 or 5 different companies, you're still going to see growth.
Yeah. And I think what's interesting is for people to look at, and I've not in a while, maybe like the Russell 2000 that has 2,000 of the largest companies in the U.S. So it's a much, much broader index, and that is a tale of 2 markets when you look at what those have done. And there's also a Russell 5,000.
Yes.
Yeah, so it's really a great index. And to me, that's more reliable to tell us how is the economy doing broadly, not just Facebook, Google, Netflix, and a few others. Instead, how's the economy doing on Main Street? And do you agree then that if people go to Russell 2000, 5000, and that's had very mediocre performance?
I agree.
Last I looked.
Yeah, I agree. A lot of, those certain index probably give you a little bit broader perspective. But here's the one thing I will challenge with that. A lot of these ETFs are based off the S&P 500, more so than the Russell 2000. There are quite a few that are off the Russell 2000 and so on and so forth. But we've been groomed to look at the S&P 500 as the most popular index in the world to base performance off your portfolio. So yes, there is a broader sense, and you can look at a broader picture. You can also look at European indexes and whatnot. But still, that S&P to individual investors is going to be that one benchmark that you're going to compare everything to.
So your argument is, and I get it, is that, look, if we're talking about how's the economy doing generally and not about where your client should be investing, then yeah, it's helpful to look at that 2 or 5,000. But if the subject is, as really it is, how do people invest reliably, then when they're buying ETFs, and I know some people know what that is, but I still want you to explain it. But when people are buying ETFs, that really, what matters to them is what's happening on the S&P or what's happening on the Dow, to the extent there's that, or even NASDAQ. So though those indexes may not represent the economy at large, if the subject is making money and they're making money and your ETF is comprised of those, then you could say maybe it's not relevant what's happening on Main Street if I'm just talking about my return on my portfolio.
That's correct.
Can you talk about what an ETF is?
Sure. ETF stands for Exchange Traded Fund. And what that is that compiles a bunch of different stocks to make up one security. So you can have 100, 200, you can have 50 different stocks that make up this one investment. It's not actively managed, so they don't trade in and out of these securities.
They tend to buy them and hold them.
Buy them and hold them. They trade just like a stock. They're a little different than mutual funds, where mutual funds you're going to pay management expenses, and they're going to trade the stocks or bonds within these mutual funds. ETFs, they leave them as is. So management fees are relatively low, and they can also be made to mirror a certain index. So they're also called index funds.
Yeah. So it's like you're betting on what you think the price will happen or the rates will be on S&P or Dow or NASDAQ.
And John, I wanted to ask you about this. There was a recent survey that stated nearly a third of financial planners say the top fear among their clients is running out of money during retirement. Are you hearing that from clients? Is that a big fear among your clients?
I'm actually pretty surprised only a third say that. I would say everybody that I talk to, that's their biggest fear when it comes to retiring, running out of money. That's more scary than dying early, right?
In some ways, yeah, because people worry about it as much.
Right.
And you hear about nightmare stories about Medicaid beds or having to go to Medicaid to your final days of your life. Nobody wants to be in that position. So it is a real concern. Some of the things that people can do to combat that, and I'm glad we brought that up, is maybe the next year we're going to have modest returns in the market. I would challenge folks that maybe are a little leery of investing right at this moment to look at filling in the aspects of their estate plan that maybe they've lacked doing for the last couple of years because they've had such positive growth in their investments. Maybe they haven't bought a long-term care policy or a hybrid policy because they're used to getting 12% off their investments. And as long as that keeps going on, I'm good. But maybe it's time with maybe a slower growth rate to start looking at filling in those gaps that you've put off because you've been pitching yourself because of wonderful returns.
And do you think people, maybe they haven't planned for long-term care, and that could be, a reason you could contribute to this where they do run out of money?
Yeah, long-term care is designed to be a supplement to help pay for medical expenses or in-home care or nursing home care later in life. It is an insurance product. There's a lot of policies out there that if you don't use it, you lose it. There's also long-term care hybrid policies that if you don't use the long-term care, you die prematurely, you're going to get a death benefit payout. So your money hasn't gone to waste. It's a good time to look into that, I think, especially for now. And if you haven't and you're in your 50s and 60s and relatively good health, it's probably a good time trying to figure out how you can supplement possible medical expenses later in life.
But one thing, though, I can tell you from TuckerAllen's experience is that policies related to long-term care have become a very difficult thing to come by now. Those who jumped into the industry early, they had very unreliable actuarial data, and they didn't realize that the cost of people living a long time is going to be very, very expensive, especially with medical technology, pharmaceuticals, et cetera. So it almost brought GE down. It may still bring GE into bankruptcy. So here you have this giant, this icon of industry. And Jack Welch, handed it over to, who was it, Jeff Immelt. But what GE did early on was they had this GE Capital, a subsidiary, and GE Capital decided to invest in getting on this bandwagon of selling these policies to people who may need some sort of long-term care. And the policies were too generous. So the reserves were miscalculated, and all of a sudden it becomes this this cancerous thing for the company, that was silent for a long time, meaning that it didn't come to the surface that this was a crisis for the company until years later. And then what they had done was they had made the decision to get out of this area, so they sold off their insurance division. And yet the buyer wouldn't take these policies without some sort of guarantee on the part of GE that they'll pay it. So they spun off this company called Genworth. And Genworth, at that time, continued to sell these policies for a period of time. So you see that name a lot out there when you're looking. Anyway, so because GE had backstopped, had guaranteed these payments beyond a certain level, they were on the hook. And to this moment right now, GE's fate, when you read about it now, they're trying to figure out how many billions should be in reserve. And there's this big SEC investigation or inquiry as to whether they properly projected what these reserves would be, because they showed these earnings for years and years and they didn't acknowledge this sort of sleeping problem. Mm-hmm. And so now some estimates are that in excess of $30 billion needs to be placed in reserves for these claims. So this little vignette is just to say that so many companies watched this and saw that this can be a nightmare, and they felt they couldn't price it high enough in terms of premiums for them to be able to sell it. So the last I checked, and I haven't checked in a year or so, but there were like 2 companies in the United States selling it. So it's something that, as you point out, there's a need for it. There's a definite need. And they need to figure out a way to monetize that so that it can be profitable for a company to sell it and still possible for people to pay for it. But I would hurry to add that Medicaid is a practical solution for those who can qualify, but it does mean a lot of planning in order to qualify.
That's correct.
Yeah, which is a TuckerAllen thing. So anyway, I just wanted to kind of clear that up for some of the listeners that were thinking, Hey, I may go out and buy a policy tomorrow. But.
Yeah. And John, typically the first 3 years, I believe, of retirement is where you spend the most. That's the highest spending. And then it sort of dips off.
Why is that?
Yeah, why is that? And do you expect to see that, within the next few years for, those entering into retirement? Do you think some may be reluctant to do that?
I don't think so. I think, there's 3 stages of retirement. There's the go-go, the slow-go, and the no-go.
I like that, the go-go.
The go-go is, you're making up for lost time.
Yeah.
You've been working a lot. You haven't gone on those vacations that you've wanted to, so you're making up for that lack of fun. And you're going to do that in the first couple of years. And, of course, to travel and to buy those cars or the boats that you've wanted, it's going to take money. And then you hit another stage, and that's the slow-go, where you're not getting around as much, you're not traveling as much. And then you hit the last stage, which can be as equally expensive as the early stage, in that, you might have some medical
I was going to say because of your health declining, sure.
But I don't think the pandemic is going to be the cause of people to slow down the spending in the first 5 years or 2 years, because I just don't think that this is going to affect the market longevity beyond 2022.
And I think the point that was raised earlier about people are, COVID fatigue and they want to go on these vacations. And we will see people going back, taking cruises, taking flights to Florida or wherever, to Europe, because they do want to get out.
Well, and the frustrating thing about it is, though, the people we're talking about are the ones who are most vulnerable to the COVID.
Well, yeah.
So it's very frustrating that they do feel a little bit of a sense of urgency while they're still able physically to be able to go and travel and walk and tour, do those wonderful things that they look forward to. So on the one hand, they're the ones who feel the most pressure to go out and do that, the desire, we would argue, urgency. And then on the other hand, we do have the fact that they're conscious that they're the most vulnerable. I don't know how you reconcile that except with the optimistic expectation, which I have, incidentally, sounds like you do too, John, that there's going to be a vaccine and it's going to work and it's probably going to be widely distributed by the end of next year. Do you believe that?
I absolutely agree. I think, and I am not a doctor, I am not an MD, I hope, I guess I should say, that they have a vaccine for maybe the high-risk folks early to mid next year, and then for the rest of everybody, maybe the following year, or maybe in the fall, I'm optimistic that that's going to be the case.
Yeah, that's an interesting way to think about it. I know that the plan is to first give it to high-risk workers, so people in the healthcare industry, it's already settled, at least in the United States, that they're going to get it first. But then that next layer, I hadn't thought about saying, well, the next layer goes to older people. Mm-hmm. But it should. I mean, once you've protected them, then the young people can run around and assume what risks they're going to assume, largely impervious, meaning they may get it, but in vastly large numbers, it's not a serious problem for them. So you're right. If you take that second round and limit it to people who are older, that makes sense to me.
I think it does, and I think that's a good way to bring it out to everybody. And I think once the vaccine is readily available, there will be a fair amount of people that want it. So getting it in the right hands first and foremost is going to be beneficial for everybody.
But don't you think even if there's not a vaccine, even those folks entering retirement are really experiencing this COVID fatigue and saying, you know what, I'm not living in this bubble anymore. I've worked all my life. I've reached retirement. I'm going to enjoy it and take those risks.
Those. Yeah, I know some of those people.
Yeah, I think if I was entering retirement within the next year or so, I would be one of those folks.
Yeah, I mean, willing to just assume risk. In other words, no vaccine, but just say, look, time's passing quickly. I don't have that much time. I'm healthy right now, and I'm going to do some traveling. I'm going to be careful. I'm not going to be reckless, but
right.
I'm not going to stay in my house to eliminate any possibility of getting this because the price is too high. The price is too high in terms of what I forfeit at this point in my life. The way that you expressed retirement just now is something that I think is worth thinking about. I'm going to remember that because it answers a lot of questions for me about the various experiences that people have when they retire. You have people who retire and they go. That first phase you said a while ago, the go phase, the slow go, and then the no go. Those kind of thinking of it as three phases, and not implying that each is equal. And as a matter of fact, not even implying that you necessarily fully get to some of those. I mean, you may get to it briefly at the very end, which is what we all imagine, is we imagine that first phase go ends up taking us to within a week of our passing, right? And then we slow down, and then finally we just have a heart attack or something, whatever we're doing. That's the way you'd like to go out of the world, where there was no period of incapacity. There was no nursing home. So some will be. For some people, their retirement will be all go, and those other two periods will be negligible, if at all. But we also know there'll be some people who that third, maybe they'll retire in good health and their go period could be 6 months and something happened, whether it's a stroke or whatnot, and all of a sudden they go past slow go all the way to no go.
No go, yeah.
And they may be there for a period of time. So it's an interesting way to talk about, and for our listeners to think about retirement, is to think about it in terms of those three periods, knowing that we can't know what percent of our retirement years will be dedicated to each. But perhaps we can look at family history. We can look at our lifestyle. I mean, is it somebody who's been reckless in terms of not exercising? Do they have high blood pressure? They might.
Other health issues, sure.
And the implications, though, are big because it affects everything, and especially affects the money, how you allocate what funds you have left for your retirement.
Yeah, as a financial planner, I always do a financial plan, and I take somebody. I assume people are going to live to 90, right? If we can make that projection, and they pass away at 65, they're not going to outlive their money, done. Right? No harm done. The problem is when you get somebody that says, well, I'm going to only live to 70, that's it, and then they live to 90. That's going to be a real problem.
Then there's harm done.
But if we knew how long we were going to live in retirement, I could tell you on what day we should start taking Social Security. We don't have that crystal ball, so we have to err a little bit more toward the conservative side in hopes that, we don't outlive our money. But we also want to allocate enough investments to where you're also earning a pretty good fixed income to carry you on. And the only problem that I see with folks spending too much early in retirement or running out of money is really the folks that didn't sit down with a financial planner and plan this out, that are just doing this on a whim.
So they didn't do their homework.
They didn't do it. They didn't do their homework. So if you sit down with a financial planner and you really look at your balance sheet, your cash flow for the next third of your life, you can come up with a financial plan and know how much you're going to be allowed to spend every year.
And that brings me to our next point, and I know we've talked about this before on the show, the 4% rule. Can you explain that again and the purpose of it?
And is it still valid, do you think, generally?
I think the 4% rule is still valid. It is a rule of thumb. If you haven't saved a penny in your life and you want to start today and you got 2 years to retirement, you can't plan on taking 4% of your net assets out. There's just not enough. But if you started earlier, and I call it Rule 10-4 before you're retired, you contribute 10% of your net earnings to a retirement fund or some sort of fund to help
Maybe
get you
tax
through retirement.
deferred, such as a 401k or something.
Absolutely. That's the most common one. And you plan on only taking out 4% for the remainder of your life. Chances are you're not going to outlive your money. It's not a guarantee, but that's a good chance. So if you're retired and you take out 4%, we got to know that some years the market will return 10%. In some years it'll return -5%. But the market averages 6 to 7% return over the history of the market being in place. So if we look at that, we're going to be able to weather a 4% withdrawal over a period of 30 years because we're just going to have many more good years than we are going to have bad years.
And so that would cover generally, historically speaking, that would cover 30 years.
That would cover 30 years if you've started early enough. Like I said, if you started too late, you're going to need to make up a lot more money because you need things to appreciate at a much more rapid pace.
If you're just joining us, we have John Gallia, certified financial planner of Gallia Wealth Management Group in Creve Coeur. John, what I want to know, what do you tell the folks that do run out of their retirement money? What options are there for them? I mean, maybe getting a reverse mortgage so they get some fast cash.
Yeah, reverse mortgages, they're kind of they're a tricky subject. But it is a resort. If you need to get equity out of your house, that could be an option. Refinancing could be an option, especially today at lower rates.
Talk about those differences, though.
Reverse mortgages, basically what you're doing is you're taking money out of your house every month to help with your expenses. So what happens is your heirs, if you were to pass, would get basically the remainder of the equity you had in your house, and that's taken out on a monthly basis. Refinancing your house is taking equity out, a large sum of equity out at one time, and then paying that off month to month over 30 years, 15 years, or 7-year arms, depending on what's advantageous. You have to go through rigorous process through refinancing. Reverse mortgages, typically they're a little less involved than doing a refinance, but those are two options.
And it's worth noting though that with if you're looking for a reverse mortgage or you're considering it, keep in mind that you don't have to make any payments. That's its virtue. Maybe its only virtue is that, that's harsh, but its big appeal is that you don't have to make any payments, and you know that your house is going to be paid for as long as you're there. And then ultimately, and remember, there has to be enough equity for this to be attractive to a lender, but assuming that you're the right age, and they'll do calculations based on your age to determine whether there's enough equity. So it's all a matter of your survival curve or the actuarial table. So it's a little like life insurance in that way.
It is. It's a unique product, and like I said, it's a last means if you need to get money out of your house. Now, here's what I will say. Hopefully you've done enough financial planning ahead of time to where you're taking advantage of lower rates, and you're using your finances as leverage right now, where you can earn 4 to 6% in the market on average every year and you're paying a 3% mortgage, you're probably better off leaving a little bit more money in the markets than you are paying down your mortgage at 3%. So you got to look for a reverse mortgage to work. Those are people that typically have a lot of equity in their house. They've either paid it off early or put a lump sum or, have been in that house for a long period of time when they probably could have done something else, with their money. Now, paying off your house isn't necessarily bad, but when it comes down to your house only being the only asset you have left to take money out of, well, there was a problem somewhere in the planning.
It is a matter, though, of, as you point out, thinking about how much are you paying in interest and how much are you earning in interest. Now, often that's a negative relationship, meaning that it's costing you more for your interest than it is that you're earning, at least in this market, even though interest rates are low. Still,
right.
It's difficult to get a great rate of return. But keep in mind, though, that to the extent that you tax deduct the interest that you pay, then your effective rate of interest is lower than the rate of interest that's quoted to you. It's called the nominal rate. So that is a matter of deciding whether or not you're going to take free cash and use it to reduce debt. And what you're pointing out, I think, is that whenever you do that, you have to keep in mind that it's reduced your options. And to the extent you had a crisis, you may not be able to go back to a bank and say, I need that money back that I paid down on my mortgage. I need to take out a new loan. Because remember, they're going to want to see income coming in. And when you're retired, you probably don't have much income coming in. So the basis for most loans, home equity loans included, is your ability to repay. And they look for some sort of guaranteed source of income. And Social Security is usually not a sufficient source of income.
Correct. Or it's not enough income. In most cases.
Yeah.
So tell me other conversations, though, along these lines that you might have. So somebody in Jill's scenario, somebody just, whether it's failure to plan, whether it's something catastrophic that may have occurred in their 50s, maybe as a child that I've seen all sorts of things in my career as a lawyer where I've seen where kids go out and get in trouble. I'm talking about adults. I shouldn't call them kids. But they're adults. Adult children, they go out and get into trouble. And sometimes you'll have parents having to bail them out, whether it's a bankrupt business, whether it's a criminal lawyer.
Yeah.
I'm thinking of several cases. I say
Rehab.
Rehab.
Yeah.
And we're talking about tens of thousands of dollars, maybe above $50,000 in attorney fees when you have, serious criminal cases or other litigation that can happen. And so when you have that person come into your office, let's assume they're over 60, and whatever the story, there's not a lot of funds there. Tell me how the conversation goes.
And that has to be a tough one.
It's absolutely a tough conversation. The best option, if they don't have the funds, they've already spent those funds, they have to reduce their spending. No ifs, ands, or buts about it. You have to look at your balance sheet. You have to look at where your money is going and find ways to cut costs.
Do you also talk to them about increasing income or continuing income? You
can increase income. It's very popular right now if you're in your 60s to have a part-time job to supplement income. Any kind of benefit you can have or income coming in, especially if you're under 65 and you're not quite Medicare eligible, it's good to have that extra income or maybe some benefits to take you up to that point. But sometimes it's absolutely necessary to continue some kind of employment, especially if you have niche skills that can be carried on. Retirement may look a little different in the earlier years. What you may be doing is retiring from your full-time job, but not quite retiring in full. I have this conversation a lot with my wife. She's in education. Well, she reaches full retirement benefits at 52, and I keep telling her, "You can't retire at 52. You'll go mad."
52. That's probably not
right.
It's probably not even healthy. I'm sure some people can thrive without a job to go to. They have enough hobbies and disciplines, but I would go nuts.
Yeah. Just the isolation, I would think.
I agree. At 52, you're still relatively young.
Yeah.
But yeah, having a second job to take you to Medicare eligible age, which is 65, is going to be advantageous. So you have to plan ahead for things like that. You know, if you do take out a large sum of money and you've had a financial plan, chances are you want to reduce your spending over the next couple of years to make up for that. It's just what you have to do.
Mm-hmm.
Yeah. So the bottom line is, at the threshold of retirement, certainly sooner, but I'm assuming the people we're talking to, some may be at the threshold of retirement. At the soonest point is to get in, talk to somebody, and talk about, what is the plan? Where will the money come from? How do I spend in the meantime? What will my lifestyle be like later on? And to think of it through that lens that we discussed a while ago as these potentially 3 phases that would be very different. The costs would be very different. And you might be able to assess the probabilities that you'll spend most of that time in one of those phases more than the other. Certainly without the ability to know for sure.
Yeah.
But you may be able to assess probabilities based on your individual case. That's a very helpful sort of model to think about retirement. Is as you put that, I want to remember
the
that.
go-go phase.
Yeah, go, slow go, and no-go.
I'm going to go out and trademark it now since you guys are so high on it, right? I can get paid whenever somebody says that.
There you go.
It's not an original idea. I got to come clean with that.
But it is good.
Absolutely.
Yeah, it's a good way of looking at it.
Well, time has flown.
Yes, it has.
John Gallia, always a good guest. We'll have to have you back again to talk about financial matters, probably the most popular topic for this show.
And we want to see pictures of your kids the next time.
Yes, Jill.
I got plenty of them. I got a phone full of them.
Okay.
And I can assure you Jill will remember that, and I can assure you I probably will not. Anyway, it's wonderful to have you back on the show. This has been another episode of Elder Talk. Till next time, take care.
You've been listening to Elder Talk with TuckerAllen, providing intelligent answers for those thinking about their future, with Attorney-CPA Joe Cordell. Sponsored by TuckerAllen, your estate and elder law advisors. For more information, visit TuckerAllen.com. Listen again next Saturday for another edition of Elder Talk with TuckerAllen. The choice of a lawyer is an important decision and should not be based solely on advertisements.